Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, February 8th, 5:07 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend. The market acts sometimes like it doesn't know that, though. The uptrend defined as higher highs and higher lows, and the market is obeying that, but it's pausing anytime we look for follow through strength. A classic case of this was yesterday's action after Jerome Powell talked or had a Q&A, I should say, at the Washington Economic Club. Big move up, then a big move down, all the gains undone, then a big move up into the close, and now today, broad selling, erasing all of yesterday's gains, still not violating any critical levels. We'll update it all when we look at the chart. So let's check over here at the trend gauge. Still flashing bullish on market leaders. More of the 21 over 21 list is red on the week than is positive. So and I've had 3 stocks break below the 21-day moving average. So a sign that some things that had been obeying the ADMA are breaking and pulling back closer to the 21. A couple that were riding the 21 last week broke through it. Just time to be not really the time to be putting the pedal to the metal down, certainly until we see some indication that the market wants to hold these levels. If you follow me, that the more times you pound on support, the weaker it gets. And there's a big support area right around 4,100 that the market has knocked on several times. And if that gives way, we'll have to get a lot more defensive in a hurry. But till then, giving leaders the benefit of the doubt. Also, all 5 of the major moving averages trending above their 21-day moving average. That's our short-term trend indicator. Also trending above their 50-day moving average. That's our medium-term trend indicator. Long-term trend is mixed, and I put a little bit more info in here as to what I need to do. Or need to see. So basically, we've got the Dow and the mid-cap index just barely sloping positive on their 200-day moving average. The small cap index is basically flat, and the S&P is just dropping now by 1 point a day. The NASDAQ 100 dropping by about a dime a day, but still trending lower. So we're working our way toward the slope of the line improving. The slope of the line really dictates whether that particular time frame is in a downtrend or in an uptrend, or in this case, mostly flat is what we're seeing. But that's certainly a positive if you click back to the end of last year when all 5 were in a downtrend. So getting there slowly, but hard to make progress. And with all of the crosswinds blowing from a macro standpoint, it's really no surprise. Earnings coming in a mixed bag. A lot of companies laying off workers. That hasn't trickled through to the employment numbers yet. As you saw, a big, strong jobs report last Friday put the jinx on any optimism that Jerome Powell showed the prior Wednesday. So a lot to deal with. We cut back a little bit today as some stops were hit and just some things not outperforming the way we wanted them to. We'll go through that when we go through the chart. So as I said, broad selling, Tuesday's gains, gone with the wind. That's a Leonard Skinner song, Tuesday's gone with the wind. Don't like to see it, but it is what it is. It's a fact, and we deal with facts here. So the G6, this is our growth index, down 1.5%. S&P gap down 0.45 at the open, and just kind of had a lower bias all day. Broke lower at around 10:30, and then a tight chop with a downward bias into the close, down 1.1%. NASDAQ 100 fared worse, down 1.8%, as Google got slapped, minus 7.7%. So they were demonstrating their AI chat bot, and it gave false information that was pretty easily fact checked. So if you do a lot of reading, not a lot of people are not impressed with AI. Basically, it's scraping the internet to present data. Well, if you scrape inaccurate data, you're going to present inaccurate data. So there's a lot of curation of content that needs to be done along with artificial intelligence. So uh, not a good day for Google there. Dow Jones Industrial Average losing the least, so showing relative strength, down 0.6%. Mid caps down 1.2. Russell 2000 down 1.5. Global Diversified 60/40 down 0.41 as bond prices were positive on the day, meaning yields gave it up a little bit. Not much though. In-house GROTECTION down 1.43%. We were hit with two of our holdings did secondary offerings, and that basically accounted for the loss versus the S&P 500. We'll go through that again when we discuss when we go through the chart. So let's get into what we do here at Revere, including the tail of the tape and where we stand on the indexes. So looking at this, it's just an inside day, meaning a lower high and a lower low, sitting 0.1% above the ADMA. This is our 14th session where we either undercut and reclaimed or closed right on the ADMA or closed above it. So basically we've pulled back 3 out of the last 4 days. Sandwiched in there was the big up day yesterday on Powell. Let's break this down on a 15-minute chart here. So first of all, here's FOMC last week and the rally, and then a pullback, and then another pullback that for now cemented the bottom, which is right around 4,100. You can see we undercut it but reclaimed it. Next day, this was yesterday. This was Monday. Undercut it and reclaimed it. This is Tuesday. Undercut it, reclaimed it. Later in the day, big up on Powell's Q&A session. Hard sell-off, down over 2% in, like less than an hour, and then reclaiming it all into the close. Didn't make a higher high, then a gap down today, downward bias in the morning, kind of sideways into the close, but again, still holding above this 4,100 level. Now, what's critical, let's point to a couple levels here. Let's go to the 60-minute chart for this. 4,100, well, go to the daily chart because it doesn't go back far enough. 4,100, we've been talking about how critical that this is from 11:30 and 12/1, then mid-December, then finally breaking through it late January, getting above it. Every time we test it, we hold it. Back to the 15-minute chart here. And when Powell was speaking, we were at 4113. That 4113 level was obeyed all day today. So, assuming he didn't speak, we're right where we were uh, before he didn't speak, meaning all of the rallies to the upside and all the breakdowns to the downside have resulted in nothing. So that 4113 is a key pivot area based on where he spoke. And then down below that, 4100 was the breakout level. That needs to hold also. On a 60-minute chart, you can see the 4050 level also plays kind of a critical role, as it was resistance here. We broke above it here. We tested it here. We tested it here. So the worst case we don't want to go below is 4050 should we break this 4100 area. But giving up the 4100 area is not good. And actually, the FOMC pivot from last week was 4050. So that's why I brought the 4050 level up. So we were right here before we broke higher. If we so two key levels, Powell speaking, we break below that. The next level was before the FOMC meeting. We break below that. Sandwiched in there was the bad Friday jobs number, bad meaning because it was so strong, that casted doubt on the ability to pause on rising interest rates. And then we had a bunch of Fed speakers come out today and just keep jawboning at that fact that, well, we'll have to keep rising if employment doesn't get in line because you'll have wage pressures and that's inflationary and blah, blah, blah. But the bottom line is we just watch the levels. And for now, we're making higher highs and we don't want to start making lower lows. So here's a higher high: 3950, 4015, 4039, 4094, 4195. That's just the definition of an uptrend. Coupled with that uptrend, you need lower lows, and or sorry, higher lows: 38.77, 38.85, 39.49, 40.15, 40.37, and now intraday yesterday 40.88. So we start making lower lows. That's a change in character. We start breaking support levels. That's a change in character, and you have to be prepared to deal with something like that. It could be an overnight gap down. It could be just a sell-off intraday, like we saw here on the 18th and 19th, where it looked like the market was going to hell in a handbasket, but it just paused at what then was the 3,900 support level, and the next day just took off back to the upside. 4,100, we have to keep a close eye on them for now. Those are the breakout levels that we need the market to hold up. And if that changes, we will change our outlook. Here's the NASDAQ 100. Again, really just in a tight range over the last 4 days since this gap up on the second. Um, Holding above the ADMA. That's the immediate area for a pullback that we want to see. Next up, the Dow Jones Industrial Average, which has really been going, just running in place like Fred Flintstone, the way his feet move in the cartoon, and going sideways right around this 34,000 level, very tight, losing relative strength until the last week, when really until Friday, because if interest rates are raising, that is the worst possible environment for growth stocks. A lot of the gains that we've seen in January were predicated on the Fed slowing down interest rates. Interest rates are just a nail in the coffin to growth stocks. Rising interest rates are. So the Dow is going to outperform in a raising rate environment, but losing less is not the outperforming that we're looking for. Let's go to mid caps now. Still pulling back, closed just below their ADMA. Relative strength lagging since Friday with the jobs report, after having relative positive relative strength after the FOMC meeting. IWM broke the ADMA inside day versus yesterday, as yesterday was an extremely volatile day, but closing below the 8, still maintaining this breakout level above 190. So those are the major indexes. Let's go now to really nothing. The RSP, the equal weighted indexes, were down slightly more than the market cap indexes, and really because of Google's losses is the culprit there today. Let's take a look at Google really quick before I forget. And this had a positive reaction on the second, gapped up. Uh, this was on Meta's earnings actually. Then the next day, Google's earnings pulled back, but not much. Made a higher high, but gave it all back today, down 7.7%, and breaking back below the 200-day moving average, sitting right on the 21-day moving average. So a lot of misdirection going on in the Nasdaq 100 um, since that jobs report. Since we had the positive FOMC followed by the jobs report, followed by Powell speaking and the Fed speakers being hawkish. His commentary was really, I mean, he keeps every time you hear him say disinflation, the market's happy. Then every time you see him pivot to the job numbers, which the strong unemployment, meaning they might have to raise higher for longer, and that's what the Fed funds futures are portraying is additional interest rate rises. In other words, they did the job that Powell couldn't do by making the market realize that they might have to be higher for longer. And as I mentioned a little bit ago, higher for longer is not good for growth stocks. So there's Google. Let's go to the dollar, which has been playing a very key role in what's going on with stocks. Here you can see the hiccup on Powell did the complete opposite of what the market does. Today, pretty much sideways, but with a positive slant into close. The opposite of what the markets did, as they gave it up slightly into the close. But really just a tight range day for the dollar. Back to the daily chart, you can see it's really had 3 tight closes here since 2 gaps higher. sitting right on the declining 50-day moving average, trying to break the trend that it had, the downtrend that it had since early November that stocks benefited from. Note we're getting to overbought on the dollar. So if we survive the overbought and it rolls back over, that'll be positive for stocks. Let's flip to the VIX now. VIX up 4.8% today, closed right on the 21-day moving average. This gets above this level and above the 20 level and above the declining 50-day moving average. That's a changing character for the VIX. That's going to be a negative for stocks. So definitely something to keep an eye on. Let's go to bonds. We'll start off with the broad bond index, BND, up 0.18% today. You can see after the 2 days down in bond prices, meaning interest rates were up strong for 2 days, we've just gone sideways now. Let's put it on a 15-minute chart, and you can see gap down, gap down. Uh, this is Friday with the jobs report. This is the Thursday after the Fed. You can see the Fed reaction there. Uh, Bond prices up meant yields down. Bond prices higher meant yields down. Bond prices down mean yields up. And now really going tight sideways all week. A little bit of a hiccup here with Powell's testimony, but um, you can see how tight they've been for the last 3 days, and it's critical to watch which range gets broken. If we go lower on bonds, that means rates are going higher. That's going to be a negative for stocks. If we uh, reassert ourselves the trend that we had been in since the beginning of the year that assisted with stocks going higher, that'll be a tailwind for stocks. Also note they're coming down, bonds now finally from overbought, coming down to oversold. That's the broad bond index. Here's the uh, investment grade corporate bond index. Pulled back now for 3 days, bounced, sitting on the 200 and the 50-day moving average, which are stacked together. Junk bonds, these trade more like stocks, really didn't do a whole lot today, down 0.42 along with the market. They're just riding, they're going lower, but staying above the 200-day moving average, which is uh, like having sweet and sour sauce, I guess. It's a little bit of both. And then finally, TLT, the 30-year Treasury price hammer today, meaning it made lower lows, and then price closed up, which means interest rates were uh, up early on the day and gave it back a little bit into the close. Let's take a look at the TNX. This is the 10-year. Let's put it on a 5-minute chart, and you can see higher higher rates, and then I didn't see this big give back at 1 o'clock today, and then opposite direction into the close. There must have been a auction right at 1 o'clock today that indicated that lower price like that, but it was recovered. The yield into the close. So quick drop in yield recovered by the close. Let's go to the 30-year TYX. Also dropped same time, 1 o'clock. That's when they do bond auctions. So started off higher, reversed lower, recaptured those gains after 1 o'clock. By the end, this 37.52, if we go above that, that's equivalent of 3.72%, I believe, on the 30-year. So you can see the change in the trend with it being above the 21 and above the 50 now. And that, again, all started with that jobs report on Friday doing the job for Powell to slow down the markets. He doesn't want markets off to the upside because that is feeds people's feeling of being more wealthy, and they spend, and spending kicks up inflation. So let's see what gold's doing. This looks bear flaggish on gold, two gaps lower, and then a wedge higher on lower volume. This looks like it wants to go lower. If you look at a 5-minute chart here, just really choppy all over the place. Gold up 0.25% on the day. GDX. Tried to get something going yesterday, gave it back today. And when I say try to get something going, I'm talking about Powell up, down, up, but just like stocks today, closing near the lows of the day. And really an inside day versus yesterday, but that's what we kind of saw because of yesterday's volatility. Let's check silver. Silver actually up on the day, but it had suffered to a negative reversal and then a big gap down after the jobs report, and it's now below the declining 50 and the 21-day moving average. We'll check Bitcoin very quickly. BITO down 2% on the day, continues to consolidate after it gapped higher 3 weeks ago. So those are the major indexes. Let's go to the tail of the tape now. Um, what stands out here, I didn't update this VIX here. The VIX is actually at 1963, and that was on the day up 5.2%, and it's right at the 21-day moving average now. Fear and greed dropped 6, still right on the edge of extreme fear. We'll get the AAII updates tomorrow as far as the bullish and bearish percentage. Um, Still working on the rally. News, as I mentioned, Fed speakers continue their hawkish tone. Day count, 4 days out of the last 7 higher. Those 3 days down, though, keeping us from making any significant progress. ADMA just barely above. Price is just barely above on the S&P, still above on the versus the 21-day moving average, 23 days after the follow-through day. Expectations positive as long as we hold that 4101 weekday, but that 2-7 pivot, which is yesterday, that 4113 when Powell spoke, and that 4101 continue to hold. The S4 and S3 levels held here on the Nasdaq and the S&P 500. Tight opening base, drop down, tight chop into the close was the intraday action. Not a lot up today. Bond prices, I'm sorry, yeah, bond prices, meaning yields dropped a little bit. The dollar up, cybersecurity stocks up on Fortinet's earnings report. OIH, oil services up, gold and silver up, bond yields down, 11 out of 11 sectors down, and biotech down. We'll check the portfolio in-house as well as some gaps. But the changes we made today in-house, added to AEHR, it pulled back and bounced right at the 21, low risk entry to add to our position. We did an offensive trimming on Tesla. I'll talk about it when we get to the Tesla chart. And then we gave up finally on XBI and TNA. And I'll talk about that in a minute before we go to the charts. Bottom line, broad selling gives back prior day's gains. Volume was light. So we keep a grid here. Where the heck is it? Here it is. I'm always tracking because I talk about how when I buy something, I want it to perform double what the S&P is doing, or I could just buy SSO, right? So when we start allocating money to portfolios, we get up when the market's bullish, we get up to 60% of the equivalent in ETFs that matches what the S&P 500 was doing. So think about it as a 60-40 portfolio. We get to 60% in stocks using ETFs, and then we use the bonds or the 40% in leading stocks. So this is a grid that I keep. This is the ticker. This is what the S&P was at when I made each buy. This is what the S&P is at currently. So theoretically, where do I stand on all of the buys versus the S&P 500? The sub if you add them all up, all the current positions, we're up 0.54%. But I would like that to be higher. I want that to be double what the S&P is doing. So the S&P during the holding period for everything that we currently has is up 0.91%. Everything that we currently hold is up 1.44%. The difference in that is 0.54%. So yeah, everything that we buy is outperforming the S&P 500 by 0.54%, but not outperforming to the standpoint that we want to. And when we recognize it, it's time to fish or cut bait. So one of the things that we sold today was Tesla. We never properly pyramided because it moves so fast, but we did sell half of this today for a 29% percent gain, which is really a 3R on that position. So you know, R is how much you're losing on any trade, and you want your gains to be ideally twice as much to the positive as the amount that you're risking. So if we're on a half percent size on this, we were risking minus zero point 0.5. We're up 0.15. So that was the sale that we locked in. So you have to do some selling on the upside because if you wait for everything to pull back, you're never locking in any gain. So that's why we do a combination of offensive selling and defensive selling. So today, Tesla was offensive selling. And we blew out XBI finally because it was just we were losing versus the S&P 500 and we got back to break even on the position. So XBI we sold the last we took this as high as an 8% position when it was showing promise. Let's go to the chart of XBI. Uh, but after this breakout failed, the last 4 days have been some pretty serious underperformance. In fact, note where the relative strength line is versus the last time it closed in this area. So a 130 close, it closed at 87.10. Today it closed at 87.19. But look where the relative strength line is compared to where it was the last time it was in this area. We don't want to hold things that are losing relative strength and certainly don't want to hold things that are losing to the S&P 500 because the metrics tell us that's not the way to make money. There's a certain just math that goes inside of this, and the next one, if you'll notice this, that is on the chopping block, if it wasn't so close to a massive support area, is GDX. So GDX, when we bought it at 4017 and 4106. Right now, the S&P 500 is up 2.51% and 0.29%, but GDX is down 6.7% on both of the buys. So we're losing ground versus the S&P 500. And these numbers help us make the decision to when we should hold on to something and when it's not only underperforming or not outperforming to the extent that we want it to, but is actually underperforming versus the S&P 500. That throws off the gains that we're trying to accomplish by the investments that we're making, and that's what leads us to take profits on the offensive side or do defensive selling. So um, consider it very important to track what's going on when you buy something versus the S&P 500 with the goal of making twice as much as the S&P does, and also your gainers need to be twice as much as your losers, assuming you have a 500 batting average. So that's some of the math that goes into it. Let's get to the focus list now, and first let's take a look at a couple of earnings gaps and how they did today. One that's really high on our list now is Newer. We're researching the results of the report right now, but this certainly has our attention, up 742% on an 18% gain after a nice 124-day flat base. Big breakout, big volume. Let's see how it acts. We set, as we always do with these big gaps, we set a high, we set a low, wait for the moving average to catch up to it. If we didn't take a position on the day and with the markets being down, we didn't take any new positions today except for adding to AEHR. So that was a nice gap up. Another one was FTNT, the cybersecurity uh, whole group has been trashed lately. Big gap up on Fortinet, 254% volume, up 11%, closed in the lower part, but it did clear all of this resistance around 58 recently. However, there's also resistance going back August and prior up to 64. So that's the range that it's in now. We've got our two alerts set. We'll see how it plays out. Complete opposite end of the spectrum, Enphase was up double digits after hours. In fact, it was above its 200-day moving average over 250. You can see the alert that I had set here. It gapped up and then just had a brutal day. Immediate selling into the close, as if the chart, and the warning to me to stay away from this was that the chart sucked in the first place. Enphase, a former leader, failed breakout here. Massive relative weakness since December. While the market, look at what the market's doing. That's this black line. Market going higher, Enphase going down. Uh, Anybody that was stuck with Enphase took the opportunity of the gap up to get the heck out. Regardless of how good the numbers are, you got to look at what the chart is actually doing relative to the market and relative to its moving averages. And like I said, complete opposite end of the spectrum versus Fortinet and NEWR. And one other one that had a good day today is Uber, gapping up on earnings. We've been seeing travel and reopening type stocks acting pretty well. Uber actually broke out 5 days before earnings, up today on 442% volume, up 5.3%. We'll be watching this also. Now to the portfolio. I talked about we added to AEHR. We had a 1% size. Now we have a 2% size. We did put some offensive selling on AEHR when it was ridiculously extended back over here around 34. Two buys here and here around 34. Tight stop. It should hold to 21. They did do an offering, and we're waiting for that to be it was a very small offering, not as concerned with this one as we were on Dynatrace. Bigger offering, uh, still, considering how good the stock was acting, it's still basically right on its ADMA, so we didn't sell any of our three buys, the last two of which are underwater versus the S&P 500. The first one's still profitable on this initial gap up where it was up 16% on 410% average volume, followed through and actually made a fifth-day higher high. This is showing extreme bullishness. The company takes advantage of this to uh, some insider selling to take some money off the table. You never like seeing that. Sometimes when they place these, it gets in strong hands and it drives the price higher. We have to keep an eye on the reaction, but our risk is minimal now because of the initial buy and the gains we had there. Although, yes, we are underwater versus the S&P on the last two buys. So what's up next? GDX, already talked about that. This big support at the 30 area and the 50-day moving average. The only reason why we're still holding on to this, it's just the risk reward is skewed to not getting rid of it when we're down to where we are here, even though it's broken below the 21-day moving average. OI8 showed some strength today, bucking the trend of other oil stocks. It's trying to get out of this resistance right around this 330 area. Boeing put some strength yesterday. Nice inside day on very low volume. Boeing, I mean, this is almost synonymous with the Dow. It was lagging while the Dow was lagging. Now the Dow showing relative strength the last couple of days, and Boeing showing relative strength also. We still have 4% size in this. Shopify can't make any progress off the 50 level. We're getting close to where we might lock in our small profits on this one. Tesla, we did the +3R sell today when it hit the 200 area. Notice this 198 area has been resistance, and this is where it kind of stopped going up. Resistance there. Then on the flip side, we've got big resistance above 200 from here, and back here up to 206, up to 216. So it's coming into a big area of resistance. We had a 30% gain on it, and the declining 200-day moving average is coming down to meet it also. So we'll hold this small percentage that we have. It's one of the strongest stocks in the market, but as I said, you got to respect the math by doing offensive selling and locking gains in when you're extremely extended. And this is 21% above the 21-day moving average, 32% above the 50-day moving average. So the odds are it's going to slow down when it gets that extended, and that's what you've seen over the last 5 or 6 days. What's left? Bros, not much to talk about on Bros today. Sitting right on the ADMA. 40 is a wall of resistance for this, that 3940 area. AEHR, I already went through that. DT already went through that. TMDX. pulled back again today. Lighter volume still holding above the 21, and ON uh, a nice tight inside day, lower volume than yesterday, still elevated, but holding up just fine. And that's a portfolio review, and that's going to wrap it. So, broad selling, giving back the prior gains. Market can't make up its mind what it wants to do. Anytime some strength comes in, it's followed by selling, but we're holding key support areas. And as long as we hold those areas, you give the market the benefit of the doubt, those areas being that 4,100 breakout area, and then a little below there, 4050 was when Powell spoke last week. But if we give those up, as well as the ADMA, we've been, 14 days above it. We're still 1.7% above the 21. That's another area for a potential bounce. The 21 will actually be above 4050 tomorrow, so that's a good sign, because 4050 is what we're weighing on with the FOMC Powell pivot. And anytime you get a strong moving average above that, it's another layer of support uh, to factor in there, so that's a good sign. But certainly not smooth sailing by any stretch of the imagination, despite the fact that we're in an uptrend. That uptrend is being challenged by the macro headwinds, and that's going to wrap it. And why do we talk so much about protecting the downside? Because of this chart here. You didn't think I was going to get out of this video without showing the chart, do you? Last 13 bear markets, they all occur below the 200-day moving average. It's no coincidence that once we got back above the 200-day, we started adding exposure as risk is minimized, but you still have to respect the short-term moving averages once you get back above the long-term moving average. We also are pivoting from early correction from the bear market. We got the moderate underperformance out of the way, as we always do, coming off the bottom. And now we're right here, late bear market or early bull market, where we're basically have our risk in line with what the market is, which is about around 1.0. And if we're set up so that we'll stay in line with the S&P 500, and if good growth stocks with proper fundamentals and breakout of sound technical patterns, we can take our shots and get our outperformance that way, the way we do when we're in a bull market or a strong bull market, as we've demonstrated in the past. So that's what we're looking for. And with that, I'm going to wrap up tonight's video. Wednesday, February 8th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.